Good afternoon. My name is Amélie Ferron-Craig, press officer for the Bank of Canada, and I will be moderating this press conference. So Deputy Governor Gravelle is pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone that my colleague will be passing around. We also have some journalists participating remotely today. So we'll do one round in the room first, and then we'll turn to the call and make sure everyone gets a chance to ask their question. And the Deputy Governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil et libre à vous de poser vos questions dans la langue officielle de votre choix. So we will start with Julie from the Windsor-Star.
Good afternoon. Julie Coates is from the Windsor-Star. You mentioned earlier that this was your first time in Windsor, and I'm wondering, can you tell us why you're in Windsor today?
I'm in Windsor today to have provide a speech to the Windsor-Essex Chamber of Commerce, but in particular, we at the Bank of Canada, our deputy governors and the governor, are keen to understand what's happening in various regions in Canada, to understand how the economy is growing in a particular region, what are the certain factors that are driving that growth, understand what's happening in terms of labor markets in that particular region, more on the ground, and get a better perspective on what Canadians are facing in particular. So today I had a speech, I met a lot of people at the Chamber of Commerce, and I also have another engagement tonight with some more people in the business committee.
Hey, Chris with CBC Windsor here. Sorry to interrupt there. We heard you talk today about housing supply. When we talk to builders, they point to inflation and interest rates as some things that prevent them from building. What are the messages that you want to send to the builders of these houses as you talk about supply rate, considering the rate continues to stay the same?
So there's a lot of factors that affect housing supply. As I mentioned in the speech, Canada has been in a chronic period of undersupply. Of course, interest rates play a role in the capacity for developers to finance some of the buildings, but we've had low interest rate periods where we've had undersupply. Now we have a high interest rate period that we've had undersupply. So it's very clear that it's not a single factor. The interest rates are not the single factor holding back housing supply. I mentioned some of the factors. It's a very complex issue, a lot of variety of issues affecting housing supply in Canada. Some of those are related to a slow process for municipal approvals. There are and some of it's related to shortage of construction workers. But there's a variety of issues out there, and it's a very complex issue. And we are happy to see that all levels of government are paying attention to that, and hopefully they'll continue providing more changes in their policies to increase the housing supply, or alleviate the housing supply issue that I mentioned in the speech.
Thank you. Chris Campbell with CTV Windsor. I'm just hoping you can provide some advice to Windsor-Essex residents in a community where food bank use has doubled over the last year and homelessness continues to grow. Some advice between now and January 24th for affording the holidays, knowing that we're in the midst of the holiday season. We at the Bank of Canada are very cognizant that people have been facing a lot more hardship related to increases in prices of all kinds of things, in particular food. In that respect, food inflation is too high. It's coming down, but it still remains too high. I mean, our goal is to bring inflation down more generally, including food inflation. And in doing so, we have one instrument, it's our policy rate. And in using that policy instrument, we're aiming to slow the economy down so that all kinds of inflation, including food inflation, continues to come down and allows more people to live within their means. Inflation hurts everybody in Canada, and that's why we're working hard to bring inflation back down to 2%.
Thank you. We'll now be going to journalists on the call. So I'd just like to remind people to mute their line if they're not asking a question. So we will be starting with Paul Vier of the Wall Street Journal, then going on to Eric of Bloomberg, and then Max Sato of Mace News. So you can go ahead, Paul.
Mr. Gravelle, in the speech you said that we need to see further progress on inflation, and you tried to play down October data as just 1 month of figures. Can you quantify what you and the bank mean by further progress? Does inflation have to be at or near 2% for a certain number of months before rate cuts can be entertained?
I think I mentioned it in the speech. What we're really focused on is underlying inflation, core inflation in particular, and we're looking to see how that and other measures of inflation are on a sustainable path to 2%. Doesn't mean they have to be right at 2%. So one of the things to get more comfort that we're on a sustainable path is we're looking at these other indicators as well as that I mentioned in the speech. We're looking at wage growth. We're looking at firm pricing behavior. We're looking at inflation expectations. These and what we're seeing in the data will be informative in terms of us understanding if we're on a sustainable path to 2%. That we're not there yet. What we've said is that we saw 1 month of good data, and 1 month doesn't make a trend. Given the other factors, the other indicators we're looking at, it's still pretty clear that we're not on a sustainable path to 2% yet. But we see the economy slowing. We're starting to see some good news in that respect. We assess that we no longer see any excess demand, and that should be reducing inflationary pressures going forward.
Thank you. We'll now go to Eric Herzberg of Bloomberg.
Hey, good afternoon, Deputy Governor. In October, the summary of Governing Council's deliberations noted that some members felt that it was more likely than not that the policy rate would need to increase further to return inflation to target. Were you one of those members? And were some of the members of Governing Council expressing similar expectations that rates would likely need to move higher during the December deliberations for this meeting?
Well, I mean, summer deliberations used to increase transparency to Canadians. So we wanted to give a bit more insight, be very forthright in what are the issues we're tackling and what are the discussions we're having and what are the views that are being brought to the table. So we wanted to be a bit more transparent with Canadians. It also wanted to be very forthright in terms of the variety of views that we bring to the table. In a sense that we thoroughly hash out all the issues hitting the economy. We thoroughly hash out all the perspectives that might be useful in terms of understanding what's happening to the economy. So in a sense, we want to bring that diversity in. And one of the ways to bring that diversity in, we actually have now a non-executive deputy governor. So we really think that diversity of views is really important. In the October decision, we came to a consensus view that we needed to hold the policy rate at 5%. We did discuss forward-looking scenarios where some of my colleagues had different weights on these forward-looking scenarios across all of us, and that meant that some of the scenarios played a bigger role in their views versus other types of scenarios. So that's what you're referring to is basically us being transparent about what we're looking forward to in terms of what potential scenarios might play out. And again, what you'll see in the next summer deliberation that comes out on December 20th is, again, you're going to see a reflection of different views. But at the end of the day, we decide on the current policy decision. In this case, it was Wednesday's policy decision. And we came to a consensus to hold the policy rate at 5%, as I mentioned in the speech.
Thank you. We'll now go to Max Sato of Mace News.
Thank you, Deputy Governor. Judging from your speech today and the official statement, you seem to be more concerned about the upside risk to inflation because of sticky services and housing costs especially. But when you talk about the risk of over-tightening, do you actually see a possibility of that's going to hurt the economic growth rate, but inflation may not come down all the way to 2%?
If I understood your question correctly, I think you're asking about the risk of excessive slowdown. So, I mean, we've been pretty clear in our communication that we are worried about the over-tightening as well as under-tightening. We don't want the economy to slow down too much unnecessarily. However, we also don't want Canadians, as I mentioned earlier in the previous questions, to live with high inflation, especially inflation in certain categories like food inflation. So in that sense, I mean, we always keep that in mind when we have deliberations. I think your other part of the question was related to that we mentioned in our press release that we still see risk to the inflation outlook and are prepared to raise our policy rate further. That is basically a reference to what we've been concerned about for a long time, this potential persistence in the inflation profile. That persistence is reflected in some of the indicators we're looking at. We still see continued high wage growth of between 4 and 5%. We still see high inflation expectations, short-term inflation expectations, and we haven't seen price-setting behavior of firms come back to normal yet. Those are starting to move towards that direction, but we haven't seen enough data for us to be less concerned about the inflation risk, the inflation outlook that could continue. It could have a period of increases that we've seen. I'll remind you also that in the summer we saw inflation go down to 2.8% in June, and then it popped back up to 4% in August. So there's still some volatility out there, and that's why we're still holding on to our sort of our view that there are still some risks to the inflation outlook. And finally, I'll refer back to a previous question, is that although we've seen some good news in certain inflation measures in October, it's only one data point. We want to see enough information, enough evidence that we see the inflation on a sustainable path to 2%.
Thank you. We'll now go to Greg Quinn of Market News, after which we'll go to Steve Shearer, and after we'll go to Najoud from CP. So Greg, you can go ahead.
Good afternoon. I wanted to ask about forward guidance. Through the pandemic, central banks in Canada and across a lot of the developed world said that forward guidance was a bit of a helpful additional tool to underline where things were going, and it even helped maybe curb inflation when it was peaking by, nudging yields in financial markets. But over most of this year, investors have been consistently betting on big interest rate cuts, even as officials in many countries have talked about more hikes. Is this divergence significant for for bank policy now?
Okay, there's a couple of issues embedded in your question. So forward guidance, it comes in two forms. There's the form that most people know of that we used during the COVID crisis, where we committed to holding our policy rate at the effective lower bound, at the lowest level. And that's what I'll call extraordinary forward guidance. And then there's another type of forward guidance where central banks provide a hint about the next decision, largely. I mean, the U.S., the Federal Reserve Board tends to do that, where they provide views they provide a set of views that kind of hints at the next decision. That's kind of a more milder form of forward guidance. I think in terms of divergence point you were trying to raise, I think what we try to do in terms of trying to be transparent and try to have forward guidance, more transparency in general, maybe not so much forward guidance, is that more transparency allows the market participants to understand how we react to incoming data. The better they understand how we react to incoming data, the better that they sort of price in the typical way we react to income data, and they're able to anticipate better what we're going to do, either in the next meeting or in a set of future meetings. So that's why we've introduced the summary deliberation as one of the reasons. We want the market participants to have an even better sense of what we're how we're thinking about certain data. But there still will be divergence. I mean, we take one decision at a time. When we get to a decision date, we take in all the data that we've had. We take in the staff projections of various forecasts for the economy. And then as the data shifts, those things might move around. And markets will do that too to some degree, but there will always be a certain divergence in terms of where they price in our future decisions. It's not perfect. So I don't think I will put a lot of weight in the degree of divergence. Where the biggest concern when there's divergence between the market and ourselves is actually the next decision, the very next decision. And currently, the market's been relatively right on our previous 2 or 3 decisions. So it seems like they're taking in the data in the same way we are.
Thank you. We'll now go to Steve Shearer of Reuters. Steve, you can go ahead.
Thank you. Hi, Deputy Governor. I wanted to ask, Canadian bond yields have fallen about 100 basis points since October. How does that impact the Bank of Canada's efforts to tame inflation?
So we take all financial conditions into consideration when we make our decisions. Financial considerations are taken as given. We input it into our perspectives, and when we have a projection, a model, we also input that into the projection. In principle and conceptually, loosening of financial conditions usually helps improve economic growth or puts upward pressure on economic growth. But there's a lot of that's a very nuanced process. It really depends on what is driving those changes in economic conditions. Sometimes economic conditions, for example, loosen because markets anticipate the central bank to be cutting, or sometimes they loosen because they see some change in risks out there, like a change in term premium, for example. So our reaction and how we take that into account in our forecast will depend a bit on that. But our decisions also depend on a whole slew of other parameters, other factors, other macroeconomic data. And so I just want to emphasize that financial conditions is one factor in terms of affecting our decision.
Thank you. We'll go to Najoud Al-Maliz of CP.
Hi, I'm wondering what your message is to financial markets and also Canadians who are now speculating on when rate cuts might start coming to fruition.
Again, I'm just going to go back to what we're looking for in terms of in terms of the inflation dynamics. We've seen some relatively good news in terms of both the economy slowing. We believe that the economy is no longer in excess demand, which had been putting upward pressure on inflation. We saw some relatively good news in terms of inflation coming down in October. But I want to be clear that what we're looking at in terms of our decision making is underlying inflation, and we're looking for a sustainable trend in underlying inflation going to 2%. Some of the indicators we're using to assess that have been listed several times. Aside from excess demand, we're looking at wage price increases. We're looking at inflation expectations. We're looking at how firms have changed their price setting behavior. And once we get more confidence that we have seen that inflation is on a sustainable path to 2%, which includes some of those indicators, but also we look at a variety of other issues, then we might be in a position to even start thinking about cutting rates, but we're not even there.
Thank you. We'll go to our last question, which is Mark Brendel of the Globe and Mail.
Thank you for taking the question. Much of the speech talked about the need to boost home construction to deal with inflationary pressures. At the same time, high interest rates, disincentivize home construction. And I'm wondering how you reconcile these two things and whether monetary policy has a role to play in boosting home construction in Canada.
This goes back to a previous question to some degree, is that we've seen a lack, an undersupply of homes when we've had low interest rates. We have an undersupply of homes now when we have high interest rates. So it's very clear that interest rates are not the only factor affecting the undersupply of homes. There's a variety of factors that affect the undersupply of homes. Some of those are policy associated, either at the municipal, provincial government level. Some of those are related to incentives for construction workers or new construction workers to join the industry. It's a very complex issue. For sure, typically, when we raise interest rates, we want to slow down the economy, and various sectors of the economy tend to slow down when interest rates go up. Higher interest rates tend to decrease demand for housing in normal times. But what we've seen is that we had low interest rates and a lack of supply of housing in low interest rates, and now we have a lack of supply in housing in higher interest rates. So it's very clear that there's other things happening than just interest rates in terms of providing more supply to housing.
Thank you, and this concludes the press conference. Thank you very much. Merci beaucoup.